Hello traders, welcome back to the Forex Gig, where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the ultimate guide to Fibonacci trading, specifically the Fibonacci retracement, Fibonacci extension, and the Fibonacci expansion. These tools are essential for identifying key price levels, setting accurate profit targets, and spotting high probability trade setup. So by the end of this video, you would have a clear understanding on how to use each of these tools effectively in your trading strategy. So stay tuned and wait until the end of this video. You would not want to miss out. The Fibonacci retracement is a tool used to identify potential levels of support and resistance during a pullback within a trend. These levels are typically driven from the Fibonacci sequence of 23, 23.60, the 38.20, 50%, the 61.8 and the 78.6 level. Traders use this level to anticipate where price might reverse or consolidate before continuing in the direction of the prevailing trend. You can see when we draw it in this bearish market, you can see price definitely came to the 50 level before it retraced back to the downside. These levels are automatically support and resistance levels on the chart. By plotting the retracement between a swing high and a swing low, traders can pinpoint areas where market participants are likely to react from, making it a reliable tool for timing entries and exits in a trending market. And you can see we use this in a bearish trend market. So how do we use the Fibonacci retracement tool? First of all, we identify the trend, whether the market is trending to the upside or to the downside. And as I can see that the market is trending to the downside in my chart, you can see it's making a series of, in fact, for the fact that market broke a previous low, retraced back, made a lower low, this signifies that market is trending to the downside, making a series of lows and high, lower lows, lower high, lower lows, lower high. It signifies that yes, the market is trending to the downside. Once we have identified our trend, we plot our Fibonacci level by drawing from the most recent swing low to the most recent swing high. So this is the most recent swing high to the most recent swing low in a bearish market. This is how we draw the Fibonacci, and it automatically places these levels on the chart. In an uptrend, you connect the swing low to the swing high. In a downtrend, you connect the swing high to the swing low. It will focus on plotting all these levels. All our focus should be on the key levels such as 38.20 level, 50% level, and the 61.8 level. They are areas where markets commonly respect, price commonly respects in the chart. As we can see in this area, price reacted from the 50% level, and this is part of the key levels we had our eye out on. So when we wait for price to react on this key level, we monitor how price behaves at that level. We have to monitor how price behaves at this retracement level. We look for confirmation such as candlestick pattern. We can look for bearish engulfing, a pin bar, or confluences with other indicators such as the RSI or moving average to confirm this setup. So in this area, if I could not see my pattern, when price came to retest it a second time, I noticed I saw my bearish engulfing that engulfed 1, 2, 3 candles. At this area, this would have been a perfect area to enter my trade. So I would have entered after this bearish engulfing at this area on my chart. Remember, if you enter your trade, stop loss are very important. Stop loss are very important. You manage your stop loss by putting your stop loss just below, in terms of a long trade, just below the next Fibonacci level. In terms of a buy in a sell trade, you put it above the previous Fibonacci level. So it will be placed above this 50% level in a sell trade. In a buy trade, it will be below the next level. So this is basically how we can trade using the Fibonacci retracement. Then for the take profit, you can aim using the Fibonacci extension, which we will touch in the next stage right now. So Let's talk about the Fibonacci extension levels. They are technical tools that can be used to plot potential price target points beyond the current trend. They are used to project price target areas beyond the trend. Unlike the Fibonacci retracement, which focuses on pullback within the trend, the extension helps traders identify where price might move more than the trend when the trend resumes. These levels act as potential areas of resistance in an uptrend, while act as a potential support in a downtrend. The most commonly used Fibonacci extension levels are the 120. Let me first put the Fibonacci extension so that we would understand basically what it means. The most typical levels we can use are the 1.618 level. We can make use of, not only that, we can make use of the 1.61 level. We can make use of the 200 level. This is 200 or 2.618 level. We can make use of the 4.23 level. This is also a level we can make use of. These are areas that we can make use of on the Fibonacci extension. This percentage represents how far price could extend beyond the previous swing point, whether it's a swing low or a swing high, making them valuable for forecasting the future when trading using the Fibonacci extension. So how do we trade using the Fibonacci extension levels? We trade by, first of all, determining the overall market trend, whether it's to the upside or to the downside, and as we can see, price is to the downside, creating a series of lower highs and lower lows. So we plot the Fibonacci extension. You need 3 points. To plot the Fibonacci extension, you need just 3 points. Your Fibonacci extension, you plot it from your 3 points. First of all, in terms of a downtrend, you plot it from the swing high to the swing low. You plot it from this swing high over here to the swing low, the newly formed swing low. Then you place your retracement to where you place the other side to where your retracement ended. This is where your retracement ended. You place it to this area. This is where it projects the places where we expect price to react from, either the 1.27 region or the 1.618 region. These are the potential extension points that are being plotted on our Fibonacci tool, and they act as potential support or resistance areas in the market. In this case, it acts as a support because we are in a downtrend. This is basically what it acts as, areas where price might react from in the market. So we wait for price to react at this key level. So if we want to take profit at this level, once we see that price reacts and start weakening in that area or at this area, this is where you decide to leave the trade. You can also combine your confluence with your RSI indicator or your moving average. Remember to always manage your trade effectively. If you are trading in an uptrend, consider these levels as potential areas to reduce exposure to or monitor your reversals. Remember, your stop loss should always be placed above recent support or resistance level. If it is in a bearish scenario, it has to be above your resistance level. If it's in a bullish scenario, below your support levels. This is basically what it means. So the next one we are going to look at is your Fibonacci expansion. While your Fibonacci expansion is a technical tool used to project future price movement in the direction of the prevailing trend. Unlike the retracement, which focuses on pullback, expansion helps traders identify potential price targets beyond the initial trend range. Now, these levels are calculated using 3 key points on your chart. You use the start of the trend. We use the start of the trend. We will now use the extension of the trend. We will now use the potential fallback, the pullback extension, to help traders identify potential price targets beyond the initial trend. These levels are calculated using 3 key areas: the trend, the end of the impulse, and the retracement point. Now, your key Fibonacci expansion levels are 61 level percentage level, 100% level, 1.618% level, and 2.61 extension level. These levels act as potential support or resistance zones where price reacts often when trading with this Fibonacci expansion setup. So we'll see how we can make use of this on the chart. First of all, we identify the trend, and as we can see that price is trending to the upside, making a series of higher highs and higher lows. So this is basically what we are looking for in the market. So we draw our Fibonacci extension this way. We start from the point A. The point A is the start of the trend. We start from the point A, extend it to the point B, where the first impulse ends at. This is where you extend it to. While the retracement, you pull it back to a temporary reversal point to resume its trend. You can put it back to the starting point of the trend to get the expansion levels, or you can put it at the retracement point. This is how we basically set our expansion levels on the chart. Typically the same way you use your extension levels. You plot the expansion levels on the chart. When you plot them, the expansion tool is connected from point A to point B with a line and extended back to the point C. This is the retracement point. To plot these levels on the chart, as we can see, these are the expansion levels where we expect price to expand to. We have to wait for price reaction at these expansion levels. We can wait to see how price reacts at these expansion levels, giving us an idea of what we should do at these levels. When we see price is forming a candlestick pattern, a reversal candlestick pattern, or is engulfing at these levels on the chart, this signals that price might be wanting to react from this level. So when you enter your trade in an uptrend, let's assume we enter our trade from this retracement level. We enter our trade from this retracement level in an uptrend, looking for just buying opportunities. Remember, your stop loss should be below the Fibonacci level. So below this level should be where your stop loss will be. Then your expansion point should be areas for your potential take profits area. Remember, your take profits should be on these levels, your expansion levels. You can take profits until 1.61 level, or can even go further. Your stop loss is also very important, should be below your support level. This support level is also aligned with your Fibonacci extension levels. So this is where we put our stop loss. Remember to manage your risks, to protect your position if the market move unexpectedly against you. This is why we use stop loss. And do not forget not to risk more than 1% of your trading capital on a single trade using this strategy, because no strategy is foolproof. You have to better prepare yourself. No matter how confident you are in a setup, make sure you don't risk more than 1% or 2% of your trading capital on a single trade. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe, and turn on the notification bell so that you will never miss out on more trading tips and strategy. Thank you for watching, and I will see you in the next video.